Well, good morning. My name is Spencer Levy. I'm an Executive Managing Director at CBRE Capital Markets, and I'm thrilled to be joined this morning by Pete Mavoides, the President of Spirit Realty Capital. Spirit is a publicly traded REIT that focuses primarily on the net lease space. And Pete, thank you very much for joining us here this morning.
Good to be here. Thanks for having me.
Thanks for coming. And first of all, I want to congratulate you and Spirit on the pending Cole transaction. It's obviously an industry-leading transaction, one of the largest deals that have happened in the REIT arena in many, many years, so congratulations there.
Thank you very much.
But in addition to the Cole deal, I would love to know a little bit more about Spirit. Spirit is a relatively newer REIT, and not all of our viewers know about you. Tell us a little bit about Spirit and what the types of things you're trying to buy.
Sure. Well, Spirit Realty Capital was formed in 2003, went public in 2004, went private again in 2007 with some private equity funds. And Tom Nolan, our chairman and CEO, and myself took Spirit public in September 2012. So we're a new entrant to the public markets, re-entrant to the public markets, but we've been around since 2003, have a 10-year investing track record, and pretty well established. What we're looking at is we are a single-tenant net lease REIT. We focus on operationally essential real estate, which means any piece of real estate where a tenant derives their profit, and so. It's a portfolio of about 2,000 properties across 48 states.
Great. Well, thank you. Now, Pete, given your track record with Spirit and your prior work in the industry, we've gone through some changes in the industry over the last certainly 10 years, probably a little longer than that. Why don't you tell us in your words, what do you think has changed in our industry over the last decade, and what has stayed the same, particularly in the net lease space, as things to do with credit underwriting, length of leases, things like that?
Yeah, and I look at our industry, my industry, as the net lease industry, and so we're a very small subset of everything that's going on here today. But the net lease market has really grown up. It's become a much larger, more appreciated market, with some $10 billion enterprise value companies in the space. I think the institutional investors are more aware of the space. For a long time, a lot of people didn't understand triple net, and now that we're getting bigger, more established, and some people are taking note, and a lot of capital flows are coming into the space, and it's an exciting time to be in the net lease space. Our Cole transaction, make us about $8 billion REIT, and there's a lot of big players.
So it certainly made it more competitive out there, and because there's more players, more capital flowing into the space. Prices for certain of the most desirable deals have compressed substantially. How does Spirit maintain its competitive edge in that type of market?
Yeah, first off, we have an improving cost of capital, being newly public, and our stock prices perform pretty well, I'm grateful to say. But we have, as do most people in the net lease space, we have a very kind of specific focus that we target. We target kind of middle market, non-rated tenants. That said, about 20% of our portfolio will be investment grade. But we're really flying under the radar screen, focusing on credits that aren't readily bankable by the big, Fortune 10 banks in the country, and finding, providing capital for partners that don't have a lot of capital alternatives.
Well, let's dig into that for a second, because I think the credit underwriting question is one that we get into a lot. And I think there's a big pool of investors once you're in the investment grade category. But once you dip one or two notches below that, the market tends to be less competitive, there's less buyers out there. But that tends to be an advantage for firms like you that do deep credit underwriting. Do you agree with that?
Oh, I agree wholeheartedly. We firmly believe that we get rewarded for going down the credit spectrum and underwriting credits and underwriting units and real estate and unit level performance. And we spend a lot of time in our IPO process kind of dissecting what that means from a loss perspective, and we're confident that the risk we get going down, the risk we assume going down the credit spectrum is we could get rewarded for that twofold.
Sure. And now when we do the credit underwriting, and obviously some of it's credit rating related, but really it's not. It's really the industry, that specific tenant's metrics. Is that correct? How much are credit ratings playing into your thought process?
It's really, our investments are a blend of corporate credit, unit level fundamentals, and then real estate. And so, all three of those weigh equally, and they balance against each other. And it depends on the specific investment, but they do weigh against each other.
Okay. Market focus. While Spirit has assets all over the United States, you have kind of three areas. You have an area from Texas to California, sort of the Southwest. You have stuff in the Southeast, but you have there seems to be a concentration in the Midwest. in Michigan, Illinois, Indiana, Pennsylvania, Wisconsin. Now, the Midwest is a market where you can get better value when you go in, but I think it's fair to say a lot of institutions don't go to those markets. Tell us about your investments in the Midwestern market, whether that's an area that you think you might be growing, and what some of the positives and negatives are about those markets.
Gotcha. Well, first I'd start off in saying, we're diverse across 48 states, and geographic diversity is an important tenet of our portfolio construction. Our largest tenant, Shopko, is based in Wisconsin, and they represent, on a pro forma basis, about 16% of our NOI. So we have a large, and they operate in Wisconsin, kind of radiating out from there, kind of going west. And so they account for our geographic concentration in the Midwest. As net lease investors, we're looking at stable, long-term, predictable revenue. And we find companies like Shopko and our other tenants in those markets have that profile. They may not have the growth that a lot of 24-hour cities have, but we're comfortable with the long-term prospects of those companies.
Yeah, and that's a factor we talked about in one of our prior interviews, is the growth factor. In the Midwestern markets, so you're prepared to get a higher cap rate essentially going in, knowing that you may not get the same type of rent growth as you might get in, say, a Southwestern market. That's sort of the trade-off you're talking about?
Generally, but it's important to note that our general lease terms are 15 to 20 years fixed and has contractual rent growth. So our contract is not providing for a whole bunch of growth. We're providing for a steady cash flow to support our dividend, and so we're not banking big growth. And after 20 years, we are hopeful that the market rents will be greater than our current rents, and generally they are. It's a long period of time.
It certainly is. It's hard to predict. As in our last interview said, it's hard to predict what's going to happen 6 months from now, let alone 20 years from now.
Exactly.
So very tough. Let's talk a little bit about how you capitalize your deals. Now, as a REIT, you have a lot of ways to fund your transactions. I guess short term, you have your line of credit. You have the ability to float bonds. You certainly can issue new equity. What other types of structures would you consider, certainly for these large strategic transactions? Would you consider joint venture investments, bringing in a new investor? Would you ever consider going outside the net lease space, perhaps, if you were to do a joint venture investment?
Yeah, I think, first off, to our capital, we have public market equity, and then we have project level financing for the most part of, for the lion's share of our portfolio. So we borrow on an asset by asset basis using both the CMBS and the ABS market. On the debt side of our balance sheet. We're not an investment grade issuer, so we don't really float unsecured bonds. We just kind of borrow at the asset level and then raise equity in the capital markets. In terms of joint ventures, we haven't explored any. We are single tenant net lease guys. I doubt that we would stray from our core to do a JV, and it would be important in entering JV to understand, who you're working for first. And first, we're working for our shareholders and buying deals that make sense for them. And if a JV made sense, we'd do it, but we haven't explored a lot of those.
Sure, and I would suggest to you, and I think you probably agree, that it's somewhat unusual that as a REIT, you do a lot of your financing at the property level, but that may give you a little bit of a competitive edge, because at the end of the day, you may be able to put somewhat more leverage on at the property level than a REIT might otherwise put at the holding company level. Do you agree with that?
Yeah, you can certainly get more leverage at the asset level, and you can get non-recourse leverage, and it provides you a lot of flexibility. That said, we are trying to delever and bring our leverage down to more closer to market. We're comfortable with our debt structure. It just, I think we'll get rewarded by the equity markets for doing so.
Sure, and there's always this balancing act between when the REITs are more competitive, and this is a general statement, and when the private investors are more competitive, depending upon what the debt capital markets will provide. And so, and then you always have to deal with the equity capital markets, which is a completely different ballgame of what they think is the right answer. So, certainly.
We're certainly trying to balance all that.
Absolutely. A couple more questions, Pete. Changes in tax laws. We see a new trend where internet retailers may get taxed the same as bricks and mortar retailers, and that may have the greatest impact on the retail segment of the real estate industry, and certain segments within there. We talked on our prior interviews about the grocery segment perhaps being most impacted if people put distribution centers into markets so that they can do same-day delivery. How do you think changes in tax laws will affect our industry, the net lease industry as a whole, or do you think the impact will be very case by case?
Yeah, I don't see a huge impact. certainly not a area I spend a lot of time thinking about tax laws, and we don't have a ton of grocery anchored centers. We have more necessity-based C-stores and restaurants, which really don't lend themselves to online shopping. But I think our stores, both in our portfolio and in the country, are well located to serve the customers that go there, and people go shopping as part of their daily lives, and so it's going to be a huge shift to a huge online buying market, and I don't see a big shift coming anytime soon.
So basically, I think what you're suggesting is that your segment of the net lease industry, which is really not grocery dependent, and you have a lot of necessity retail, a lot of restaurants, they are going to be least impacted by any changes that could occur. Is that a fair way to put it?
Yep.
Okay, two more quick questions. One, when our colleagues think about Spirit Realty, what should we be thinking about to get you more deals? So just in an elevator speech way, what are the ways they, boy, that's a deal that's right for Spirit? What would be right down your sweet spot?
I always tell people, take a look at our portfolio, understand what we have to understand what we like. And our portfolio has an 11-year average lease life. It's constructed around a solid double B credit of regional, mid-market, larger operators with good unit level fundamentals and well underwritten real estate. Our average property size is about $4 million, and long-term bite-sized retail is what we like.
Great. Last question, the future of retail. Was a question we've asked a lot of our interviews. We've got some great answers, and I know you've had at least 3 minutes to think about it. I'm just kidding, Pete. But we'd love to know, given your great track record and experience in this space, what do you see over the next 10 years as changes that we as investors in net lease real estate can do to best position ourselves to be competitive for whatever changes may come over the next several years?
I think the biggest changes we're going to see over the next several years is just rising interest rates. And when you lock in long-term contracts with modest rent growth, and you're investing into a rising interest rate environment with financing, that's the biggest thing we're doing to prepare ourselves for the future of our balance sheet and the capital structure. In terms of our tenants, we've seen them go through cycles. This last cycle, we've lived with them, and they're doing great, and their credits are doing fine, and I'm confident they'll be healthy for the years to come.
Great. So I think your comment is excellent. The interest rate part of it is that a lot of people are saying, oh, cap rates are going to now go up lockstep. They don't go up lockstep with interest rates, but it is certainly something that I think you are addressing by your deleveraging strategy overall.
Good.
Great.
Thank you.
Well, on behalf of CBRE, I want to thank Pete Mavoides, the president of Spirit Realty Capital, for joining us here today. Great job.
Thanks, Spencer.
And have a great conference.
Great. Have a good show. Thank you.
Thank you.